stop posting those. So I wanted to ask you, especially when we're looking at a token issuance for the team, when we're looking at team allocations, whether they're getting any tokens, what should people be thinking about on the team side when there is a token and it's all the token launch involved?
So the view on tax and structuring of founder and team token allocation has evolved in recent years. What we're looking at is, are you taxed on the value of the token at the time you enter into your token agreement, and TGE, at vesting, or unlock if it's different to vesting? In some jurisdictions, so examples would be UK, Canada, some Southeast Asian territories, they would treat the token agreement itself as property. So when you enter into the token agreement, you've acquired property, the rights to the future tokens. So it's the value at the time you enter into the agreement that is going to set your tax position. So if there is no value to the token, then the best outcome, if you're in one of those jurisdictions, is to actually acquire your token rights at the market value using a cost-based approach under a token agreement. And that means that when you sell, that means you will only pay tax if and when you sell them, and you're most likely to be in capital gains tax regime rather than income tax. A lot of European jurisdictions follow that approach, but if there are any vesting provisions, so requiring continuous employment, then the tax point is automatically deferred until vesting. So it doesn't matter. They'll disregard that you acquired property by entering the agreement, that you paid the unrestricted market value, and actually just tax you at vesting. So in that case, if you're going to have vesting provisions, which we often see, you want to match vesting and unlock so that the tokens unlock and you can sell the tokens and pay the tax. In short, because you'll pay, and at that point, you'll be paying income tax, not capital gains tax, and it'll be the value at vesting. If you are in one of those jurisdictions and there's already a value to the token before you enter into your token agreement, for example, there's been a token agreement with a third party establishing price, then you're going to pay, if you're a founder, potentially the dividend tax, so income tax, we're going to pay employment taxes on the value you receive if you don't pay market value. So in that case, you want to structure your token agreement to defer the tax point to unlock as well. And that, yes, you'll be paying income tax at that point, but at least you have the token so you can sell and fund the tax liability. But Ryan, we've talked about this before. The US is less straightforward. There's significant uncertainty as to whether a token agreement is property. And so what we're seeing now is we know that tokens are property. So it's actually much better, if possible, to mint the token earlier before there's any value and allow the founders and team to actually acquire the token. Now we've seen kind of variations of that, like something that represents a token, as opposed to the token itself, and whether actually that's sufficient. So you actually create, I don't know, let's say it's an NFT, and you're acquiring the NFT that you later swap for your token. The question there is, yes, you might have actual property, and so you might manage the tax point from a US perspective, but when you transfer from the NFT to the actual token, do you ever dispose of at that point? And you've just triggered a tax liability when the token has value. So if you can mint the tokens early, even if not fully developed, that is better than using kind of a token agreement in the US. And I'll just cover, I mentioned the TGE. It's very rare, but we have seen, for example, when working with the tax authorities in Slovenia, they disregard any agreement. It doesn't matter if there's an agreement where you've acquired at market value or you've got vesting and unlock provision. They will treat TGE as the time that you acquire the token and the value of TGE, which can sometimes be the most valuable point. So then at that point, you need a valuation to try and bake in discounts for not being able to sell with the unlock, etc. I probably should add some more around employment taxes and social security and what you can. There's a lot of issues there. You've got to think about making sure that you're withholding enough tokens to be able to fund, payroll taxes and things like that. And if you are using an employer of record, a lot of them won't deal with tokens, although we are seeing some deal with tokens, but the payroll taxes on tokens now.